I guess we'll kick off, guys. Like the meeting's recorded, so if anyone misses out on anything or you're jumping in halfway through, we'll make sure that we send it to you at the end. So you've got it for your own, viewing capability. But let me start by introducing me and Jamie. So I'm Jo Agresta. I'm the CEO and co-founder of Abodey, an AI buyer's agent web app that helps home buyers navigate the process of home buying from start to finish. And joining me today is our partnered mortgage broker and founder of Vigeo Financial Solutions, Jamie. I'll hand over to him to introduce himself.
Hi, everyone. Good to see everyone here on a Monday evening, 7 o'clock. Coincidentally, it's the AFLW draft that's on as well right now. Unfortunately, there's not enough money in the AFLW just yet for them to be not worrying about home loans. So I reckon on the back of this, we should send all the girls a copy of what we talked about affordability. Thank you for introducing me as well as inviting me into this, Jo. We've partnered up with Abodey as a mortgage broking partner. I've been in the game for a long time now. I started as a banker in 2006. That's a long time ago, and started my own business as Vigeo Financial Solutions in 2014. So it's coming up to 10 years. But what hasn't changed is the ability to service our clients all through from when I was a banker to now as a mortgage broker and owner of this business. We have a fantastic suite of business partners like Abodey, as well as a range of banks and solutions for our clients. So can't wait to get into this tonight. There's some really topical discussions that we're going to have, and hopefully everyone gets something out of it.
100%. Thanks, Jamie. So just before we officially kick off, I just want to do a bit of an acknowledgement of our country. So we acknowledge the Wurundjeri people of the Kulin Nation as the traditional custodians of the land on which we stand today. We pay our respects to the elders past, present and emerging of the Kulin Nation and to all Aboriginal and Torres Strait Islander peoples. We recognise the ongoing connection of Aboriginal and Torres Strait Islander peoples to land, water and culture. So for today, we've gone through a bit of Jamie's background already. So as you know, he's the founder of Vigeo and me being the founder of Abodey. So my background is in residential real estate sales. That's where I spend most of my time, as well as home and contents insurance as my background. So spending a lot of time in housing industry, and I'm very passionate about home buying and helping buyers get to where they need to be. So that's where my co-founder and I, Anand, emerged with the business Abodey. So on the agenda tonight, so what are we looking at? We're going to talk about the approach to home buying. So what can you actually afford? Where can you start? Affordability, so what that actually means, how it impacts you. LVR, LMI, genuine savings. I think we've all heard those terms and a lot of people have gone, no idea what that means, totally confusing. So we're going to demystify a lot of that tonight. We'll talk about assets and debt, so what's good debt versus bad debt, as well as home loan applications. So what makes your application stand out? What do the banks look for? And then we'll dive into interest rates. So don't be scared of the media hype. We'll demystify all of that tonight. And then we'll hand over to you guys for Q&A. And a bit of housekeeping, feel free to add your questions to the chat as we go through. At the end of each section, I'll be checking the chat and answering any questions. We want to keep it an open discussion. So feel free to keep the chat open, ask your questions. We really want to engage with you guys and so you get the most out of this session because it's for you. So let's talk about the approach to home buying. Where should you start and why? So I think it's important to talk about first the standard steps that we take today and what home buyers are currently doing and where we can improve. So typically the process begins with an emotional decision. So as we all know, home buying is a bit of an emotional journey when you're looking for a home to live in. So this will be things like family situations. Maybe you've had some savings or you want to stop renting. You might be looking to upsize, downsize, or buy for the first time. You want something to show for all the hard work. And once you've made that conscious decision, what then happens is you typically will start looking at finding a home. So you jump online, you look at realestate.com or you look at those other websites. You might do a few mortgage calculators, do some research, talk to family and friends. And where this is a bit confusing and why I kind of discourage this is it overwhelms buyers, because what happens is you jump online and you're doing so much research at once. So we weren't really taught at school how to navigate buying your biggest asset. We just sort of dive into it and fumble through. So it's really important that we get it right. And in the chat, or you can react with the emojis in this session here. Can anyone tell me what's missing on this page? Feel free to call it out. But we've gone through 2 steps. We've got the emotional decision, and we've now looked at finding a home, but what's missing from this portion as a 3rd step?
Funding it.
Exactly. Thank you. I don't know who said that, but
Phil.
spot on.
Phil said that.
Good on you. Yes, that's exactly right. Finance. That's the biggest one. So often with this journey, as it stands today, buyers will start making the decision. They'll try find a home, and often that leads to the first step in the journey and some people's last step before they put it off forever because it's so overwhelming. The way we should be looking at it is go through the decision to purchase, assess your finances, and then start looking for the right fit home. When we go through finances, and this is where we talk about affordability, and I'll hand over to Jamie in the next section, but finance is where we're going to look at your debts, savings, cost of living, your spendings, assets, bills, HECS debt, student loans, all that kind of stuff adds up. Once you have a grasp on your financial situation, you can then comfortably move into finding a home, and it's not as overwhelming because you know exactly what you're looking for. The way it's done today, you do it back to front, it leads to a whole heap of confusion and can be very overwhelming very quickly. So it's important that we get this step right from the start. So let's look into affordability, savings, borrowing power, and what that all means. I'll hand over to Jamie.
Yeah, I think it was very important for that last slide where we talk about the steps of buying, and funding and finance really is a key component of it all. Much like we're going out to buy anything, number one, we have the emotions attached to it. For example, we've got an event on the weekend and we like to go and get a new outfit. That's where the emotion comes first. We got an event, we got to get an outfit. Secondly, you really want to know how much you want to spend. How much can you afford to spend? And that's a key. So that's where that finance part comes in. Same goes for purchasing a home. So let's go down to what we're looking at. What do we mean by affordability? Sorry. So Jo, can we just move down? Yep, I can't drive that. Yep. So what does it all mean? So we need to know, as mortgage brokers, we really need to know before anything else what your current financial situation looks like. We don't just need to know how much money you're making. We need to know everything about your financial situation. So how much debt have you currently got? How much income have you got? What sort of household do you run? Are you a single person? Are you married? Do you have kids? Do your kids have special needs? Do your kids go to private school? All of that will form a whole picture of your financial situation. That's right there on that chart there, as you can see. All of that gives us an understanding of your financial situation. Mortgage brokers will then take that information and then look at the various banks' policies, and the way the banks calculate affordability will match it up to make sure that you get you maximize what you can borrow. Okay, so that's what we're looking at. Again, just that house part, that slice of pie involves mortgage repayments, involves property taxes like council rates, insurances, maintenance and repairs, utilities. So just that one little component involves a lot more stuff in there as well. So let's go on the next slide. So how we measure affordability is quite simple, really. If you just think about somebody come to ask you for a big sum of money, you want to know what they look like. You want to know what money they're making, how they propose to pay you back. Have they been paying people back in the past? Have they had a history of paying people back? All right, so let's just put it into basically look at the annual income first. How much money you're making is the number one thing. How many people are on this loan? Again, that will either mean more income, or if it's just 2 people but one person working, there's more income, less income, but more expenses. Dependents, they're just the money drainer, right? As we all know, I've got 3 of them. So dependence plays a big part as well, and the type of buyer, obviously. Then we look at savings history, your spending history, spending pattern, your current debts, what assets you've got. The assets part is not as important because that only just give the bank an understanding of how you've used the money in the past. So if you're a 22-year-old straight out of school or just straight finish your apprenticeship, they don't expect you to have a lot of assets. But on the other side, if you're 45, you've been working for 20 years and you've got no assets, then the bank might ask a further question on, well, what has happened? Have you gone through something traumatic? Have you gone through a divorce, for example, and lost a lot of assets that way, or what has happened? So there needs to be a story to that. So as you can see, it's not quite straightforward, just numbers. By showing something, there is a story to be told about the borrower. Similarly to credit history, you can have a 25-year-old with no credit history because that person's never borrowed before, or you can have a 25-year-old with plenty of inquiries, personal loans and credit card inquiries all over the place on the credit file. When that happens, you have to explain what happened. So a lot of people, I hear a lot out there that people are saying, okay, I'm 22, I've just started a job and I'm looking at maybe getting a credit card just to build up my credit history. That is a good point. You do need to start somewhere where you have a credit report. When the bank look you up, there's something there to show. But at the same time, you need to ensure that your credit history is good. So if you have a credit card, but you're not paying the card back and it's going to default and it's late on payments, that credit history we don't need. But you signing up on an Optus phone, post phone contract, that's a credit history there as well. But just ensure that you pay for those. So credit history is important. And then you look at the owning a home, renting. Now, renting is important as well. If you have been a good renter, you paid your rent on time, that solves a lot of issues on that credit history and conduct part, as well as genuine savings, which we'll discuss later on. And then, goals, buying a home, buying a holiday house, or you're investing, and any other financial goals. It will also determine what your position is going to be when you're putting up for a home loan. Just by buying an investment property, for example, in the past few years now, things are changing because there is holiday rental and there is also long-term rental. So there's a distinct differences now between putting something out on Airbnb and bookings.com versus having a 12-month tenant in there. So the bank policies are changing and evolving with the way that we are now investing. So it's worth knowing all the different policies and possibilities. The good news is that you've got mortgage brokers like myself that can work with you and get to the point where you can rely on us on knowing the policy. So let's have a look at the next slide. Sorry. So like I said before, how we help. Number one thing, and it says on the bottom of the slide, and that's a misconception on a lot of people. A lot of people don't really notice. As a consumer, as a client of ours, you don't pay for our services. Our services is absolutely free for you. We get paid on a commission basis from the bank that we place your loan with. And all the paneled banks that we deal with, they have a very similar commission structure. What that means is that we are not placing a loan because of the difference in commissions. In fact, as a good mortgage broker, we would love for you to get the right loan and that you're happy and that you stick with us. So that's more important to us than what the banks think. So that's number one thing. Then we look at your financial situation. As I've said that before, we need to know your pie chart. We need to know what you look like. We need to know your financial situation, your life stage and where you're at and what you're thinking about. Once we get those details, and it's good that we have Effie in here. Effie is my admin manager. She's the one that normally goes out to our clients and grab all the details, and we need all the details there. So we need all your debts, we need all your incomes, We need you to declare all the relevant details. From there, we can get an understanding and use the bank's given calculators to work out where your affordabilities are. And then from there, we will know which bank that you fit the policy of give you the best bang for buck, give you the best interest rate, the best policy, and the quickest turnaround. Because again, everyone's different. Someone who's eligible for 10 different banks have different interest rates, but at the same time, the banks have different turnaround times. And if you're in a hurry to get things done, you might not want to wait for the bank that takes 3 weeks to get a loan application done. So all of those things that we'll know on the back of our hand, because we deal with that every day. And then what we do from there is, once we've found the bank, we propose to you what the loan look like. You like our proposal, then we'll help you with the paperwork. That means that we'll do that application. You don't go to the bank at all. You submit everything through to us. You sign the application with us, which is on the bank application paper, mind you. And these days, 99% are done through DocuSign, so you don't even need pen and paper. You can just do it on the computer. And then we'll submit it to the bank on your behalf. We'll then liaise with the bank for any questions they may have. And if there's any outstanding documentation needed or further documentation needed or explanations needed, we'll then come back to you and we'll work through, and then we'll get the loan approved. Once it's approved as well, we get the loan contract, and then we'll walk you through on how to sign those contracts with the bank. So that's our work from the start to finish. And there's no a timeline attached to that, because there's some clients that are quite early in the piece, and there's some other clients that are already ready to go. So some are quite quick. I've worked with clients over 12 months to get a home. It's just depending on the situation. But that's what we do. We look at from the start, before you even think about buying, or before you even look at a property, to at the end when you get your keys. And it's free. Yeah. So let's get back to affordability, and that's often the number one question that people ask me. What can I borrow? What can I borrow? It's determined on two big things. Number one is your serviceability or affordability of a loan, and number two is your deposit amount. Obviously, how much cash have you got? I'm not going to talk about your credit history, because I assume everyone's credit history is good. Otherwise, you tell me before we have the meeting, and then we have other plans. But just on affordability, I've got an example here on how we look at affordability. So you see, this is a dual income applicant. You've got applicant 1 and applicant 2. And we've got the gross income put in there. So that's what you earn before taxes and before deductions. So you've got your before tax incomes there. There's 2 of them added together. You've got a bank assessed gross income of X amount down the bottom there. What the bank then will do, they will take the notional, the tax rate, and they will have a net bank calculated monthly income there. They always work on the net income, what you actually hit your bank account. From there, we always ask our clients to declare their monthly expenses. So that's anything that's not a debt, not a liability. So you're going out, your groceries, your rates notices, your car rego, all of that sort of stuff. You declare what you use approximate monthly. As you can see here, the clients declared monthly, the 2 of them spend $2,600. Now, a common misconception amongst a lot of clients are, that's what we spend. However, if you look across next to it, there's a bank assessed expenses, and that's $3,979. Guess what? The bank's not going to take your $2,600 as expenses. They're going to use their $3,979. Again, I have clients to say, hang on, I can afford this loan. I know how much we spend, and I can afford it. Unfortunately, the bank assessed expenses monthly is what they use as a minimum for your application. The way they calculate is they calculate based on the applicants, where they live, how much they earn, and they've got an algorithm within their own bank to calculate that expense. This is where every bank is different. So ANZ Bank is different to Westpac. Westpac is different to CBA. Everybody has a different algorithm. So there's no way known that you can stick one figure for that expenses and be done with. This is where, again, the mortgage brokers are sticking out a little bit, because the good mortgage brokers like us will go through several different calculators if the numbers are tight. If the numbers are not tight, like this couple here, if you look at the top left corner, it says the total UMI. That means uncommitted monthly income. That means the net income they've got minus the monthly expenses, minus the loan amount that they are proposing. They still got $2,428 left net in their bank every month, based on the bank's calculation. That is a very, very strong application. So very, very strong serviceability. What it means in layman's terms is that after their living expenses, which is elevated, by the way, by the bank, after the loan repayment, they still should have $2,400 every month net in their pocket. Okay, that creates a very strong application. Anywhere that's a positive by $100 or more is a positive application. All right, it's a positive application. It means a tick in the affordability. All right. Let's go down to the bottom there where you see the new loan proposed. Okay. Now the new loan proposed. All right. I didn't take the client's name off. Sorry. The customer standard expenses and everything else. Even though you've got an interest rate of 5.79 as the loan amount, the bank will add another 3% on the interest rate. The bank will add another 3% on it. All right. That's just the way that the bank will work out affordability. So if your loan interest rate is 6%, the way they calculate your loan, they will add 3% more on it, assess it at 9% to give themselves a buffer. So again, I'll have clients saying, I worked this out. If I've got a $500,000 loan on 6%, my repayment is X amount. That's lower than what my rent is. I can pay that right now. I understand that's what it means, but unfortunately, that's not how it's calculated. All right. Bank's going to whack another 3% on your interest rate and calculate your affordability using 9% rather than 6%. All right. So after all of that, if you're still a positive UMI, you're good to go on the serviceability wise. So a lot of times when clients are asking us about working out their maximum borrowing capacity, we're looking at this number. We're looking at how much you can borrow. We put a number in there that spits out a positive UMI. The smallest positive UMI equals to the largest borrowing amount you can go to. All right. So we'll work it backwards. We'll play around with the numbers until we got a UMI that we can pass the bank with and the largest amount you can borrow. That's how we work out your positive your serviceability. So it's not an easy way to work it out. There may be brokers that will just chuck it through the calculator and work it out one for all. But the way that I do is I want to be a little bit more accurate. So I'll work through individual banks calculators to make sure I get the biggest borrowing capacity to you. And then that way you can then have a maximum amount that you can borrow and know that on the back of your head. So when you go look for houses, you're safer that way. Let's go to the next one.
So just before we move on, are there any questions that anyone has on that topic or anything that they wanted to ask, I guess, or anything that wasn't clear? Feel free to come off mute or put it in the chat.
Yeah. Cool. All right. So the other thing is whether or not you go into a bank or you talk to anyone and whatever else, you're gonna hear these acronyms, LVR, LMI, and then when you hear LMI, you're gonna hear these genuine savings or Gen savings. I just want to go through some of these acronyms and make it easier for you to understand what it means. Number one, number two, for you to work out how to work them out. Okay, so let's go through LVR first. LVR stands for loan to value ratio. The loan is the loan that you're proposing to borrow. The value is the value of the security you're putting up, or the house that you're buying, or the house you're refinancing. And ratio is just, the loan divided by the value. So if we're looking at an $800,000 house value, and we've got a $500,000 home loan, the LVR is simply $500,000 over 800, 62.5%. That's how we work out the LVR. Now, if you've got an $800,000 house and you want to borrow 80% LVR, that's $640,000 home loan. Why do we use 80% LVR? There's a reason for that, and that I'll go into the reason now so we can explain LMI on the back of that. So think about it this way. You bought a house for $800,000 and you go to the bank and wanting to borrow only 80% of the value of 800 because you've got the 20% plus you've got the expenses or whatever else, but your bottom line is you borrow 80%. The bank's going to be pretty happy with that, because in the case that you can't repay this loan, the bank can sell the house in a hurry and they can comfortably make 80% of the house value back. They foreclose your loan without losing any money. All right. This is why they put an 80% LVR there. They're safe. They've got the asset there that they can sell off and be done with. If you go over the 80% borrowing, okay, so if you don't have the 20% savings, you've got 10%, for example, and you want to go over the 80%, then the bank get a little bit nervous. Okay, all right, if you've got a $1 million house, so you borrow 900,000. 6 months later, you lost your job, you can't pay it back. The bank's got to sell it. They're a little bit more concerned about whether or not they can make back the 90%. So in that case, what the bank do, and they're not in the business of losing money, what they want to do is they want to insure against that possibility. All right, so they go to an insurance company. It may be QBE, it may be some other big insurance company, it may be an internal insurance company. They will insure that home loan. They will insure that mortgage, okay? They will take out insurance on you defaulting. Now, that's what we call lender's mortgage insurance, or LMI, all right? Unfortunately, that's a fee the bank's not going to take. So they will take the insurance out, but you have to pay the premium as a borrower, right? So that's where the LMI premium comes into play, right? So on a house of 90% LVR, you need to borrow the 90% plus the LMI insurance premium. That could be anywhere between 10 grand to 20 grand. You just get added onto your loan, and you end up with LVR of over 90% because you've got the insurance premium added to it. But just remember, that is a one-off payment. It's added onto your home loan, and is a premium paid for the insurance. If you take the loan to another bank, right, and you're over 90% again, you need to pay that again at that bank, all right? So as a mortgage brokers, if you're an LMI client, you normally don't get to move banks until you're under the 80% onto your loan LVR. How do we get there? Two things. Number one, you drop your home loan value down, so by paying it down. Number two, your house by appreciating value. All right, so that example, $800,000 house, 500. If you've got a $750,000 loan, if your house is all of a sudden worth $1 million and you still got a $750 loan, your LVR is down to 75%. All right, so that's how you avoid LMI. And yes, that for an understanding of LMI, that's all that is insurance taken out by the bank against you defaulting, and the premium is paid by you as a borrower. When you are looking at a LMI deal, so when you're borrowing over 80%, the bank will have a lot more strict rules on assessing your application. And part of that rules is to show genuine savings. All right. So, for example, if you're buying 90%, you're borrowing 90% of a house you're buying, the bank wants to know, have you actually saved before? Why do you only have a small deposit? All right. Where is this deposit coming from? Typically, we see young people who might not have saved in the past and got money from parents. They are not included in genuine savings. All right. The bank wants to see the person itself save the money. It's important. It's important for the bank to know that they're able to save money because they're about to embark on a big repayment plan for 30 years. So it's in the bank's interest to understand that this person can actually save. So these savings are coming from periodic savings. Yeah, like I said, there cannot be gifts from parents. All right. And normally these are required for any deals with a LVR over 80%. So where you don't have 20% deposit. All right. So let's go to the next one. So yeah, so again, why do the lenders care? Well, you should care because if you have a good enough deposit, you avoid LMI, and you got good terms for the bank, and the bank can see your serviceability is very high, it's easily serviceable. You've got a low LVR, then the bank is going to give you better terms, and that's in terms of better interest rates, faster turnaround times. All the favorable terms will be coming to you as a borrower. And you hear banks out there advertising. Very good example is Macquarie Bank. They are out there advertising, we want good loans. All right. If you're a good loan, we want your loan because it's less risk for them. That's all. As easy as it sounds. All right. And then there's other banks out there that will cater for people specifically who don't have those favorable terms. But again, like I said, there's always somebody out there. There's always going to be a bank that'll be able to help you. We've covered that a little bit before. Genuine savings held in accounts for more than 3 months. Some banks will require 6 months, but again, it's different banks, different policies. Term deposits are counted, equity from existing properties are counted, gifts, inheritance received. So it's got to be in there for a long time, and you've got to add to it as well. You can't just have a big lump sum gift of 50 grand from your mum a week ago and count that as genuine savings. It won't work. But you can have it in there for 6 months and add to it. That will work. All right. So it's all little tricks and trade, or tricks of trade that we know as mortgage brokers. So that's again important for you to talk to us about your situation. We often hear debt, good debt and bad debt, especially from financial planners. I'm a financial planner myself, so I often educate my clients on what's a good debt and what's a bad debt. Very easy to distinguish. After this, you'll be able to tell everybody else. So basically, any obligation, any financial obligation is a debt. Some are easily identifiable, like a home loan, personal loan, car loans. That's a debt. Some are less easily identifiable, which are things like credit card limits. You don't think that's a debt. In the bank size, that's a debt. Overdraft limits. Again, you might not think that's a debt, but when you go for a home loan application, the broker or the bank will tell you we count that as a debt. Buy now, pay later limits. A lot of people forget they got HEX, which is a massive debt at this stage as well, especially with high inflation. So debts are just basically any obligation that you owe. Tax debt, Centrelink debt, all of those things are absolute relevant. So you need to tell your mortgage broker about that. What is a good debt and what is a bad debt? So very easily identifiable. A good debt is any debt that generates an income or a return. So for example, an investment loan. An investment loan into an investment property or a line of credit to buy a bunch of shares or manage funds. Those are investments. Those are good debts on two things. Number one, the borrowing that you've taken is going to generate an income and a return, hopefully a positive one. Number two, the interest that's charged on this debt is tax deductible because it is generating a return or income. So that's a good debt. What's a bad debt? Unfortunately, everything else is a bad debt. Even your home loan that you live in, the house that you live in, that's a bad debt. However, that doesn't mean that you don't go out and take on a debt. We all need to live. We all need a home to live in. So we all have to take a bad debt at some point. However, we just need to ensure that we reduce and close our bad debt as fast as possible. So You got an investment property, you've got a home loan. Both got loans on it. One's the investment loan, one's a home loan that you live in. Which debt are you going to put all your money into? It will be this one, the home loan. Why? Because it's the bad debt. And bad debt, we need to close as fast as possible. That's the general rule. Okay, that's the general rule. So that hopefully you get a good understanding of good debt and bad debt now. Very easy identifiable.
And we just have a question in the chat, which I think you might have answered with this slide here. But Anand asked, do stocks or share investments count as genuine savings, even though they are risky investments, or just the cash savings?
No, they do. They do. So if you got a shareholding and you can show the statement of the shareholding that, it's genuinely that you've made there, that you didn't just got given by someone else, then if you held those shares for over 6 months, then we can count them for sure. Same as managed funds and that type of scenario. It doesn't change. I mean, it's no difference to you putting in 10 grand into a term deposit. You put into a share portfolio. It's still savings. You try to invest, right? It's only that the term deposit is a lot safer than a share portfolio. But there's no difference. No, you can absolutely take that as gen savings.
Nice. Hopefully that answers it, Anand.
Yeah, absolutely. I had another question from the savings. Is it super a good source of savings as well, or something from super count as savings?
Okay,
or not?
so Anand, we're really getting into the financial planning part now, and I just want to, before I do anything, I just want to give a general disclosure that I don't know anyone's personal circumstances. So whatever information I give here is of general in nature. So superannuation is a very, very good example of people's mind gymnastics when it comes to savings. Okay, superannuation is a product used for generating income when you retire, all right, or having a savings amount when you retire. So that in nature means that whatever money you put in now, you can't access it until you're retired, all right. So if you've got X amount of money in surplus every month and you are thinking of putting this money to use, you need to think about, when do I want access to this money? Typically, I would say you don't want to lock everything up until you retire, but you might want to lock something up till you retire. All right. The other thing that's very good with superannuation is the tax treatment on the money. Okay. So if you're a high income earner and, by the time you get your dollar and, it's 43 cents has gone to the tax office, you might want to think about taking some of that pre-tax into your superannuation. Okay. Because in super is taxed 15%. And what that means is that, you give some of that access, all right, you give up the access to the money, but you take on the tax benefit. You actually have more money saved away than if you just leave it outside of super. All right. So if you got $10,000 to invest, and you want to put that into outside of super investments, like anything, shares or whatever, that $10,000 after tax, after taxed on whatever your tax rate you're on, it's going to be more than 15%. You've just got to make that decision whether you want that or you want inside super, where it's taxed at 10%, 15%, and its investment capabilities are just as good inside superannuation. The only downside with superannuation is it's locked away. That's all it is. All right. Typically, if you're closer to retirement, you might look closer at superannuation investments. All right. So you might want to salary sacrifice into super, dump money into super, whatever some people have SMSFs to buy property or whatever else. But if you are starting out, young person, high income earner, I would say, put some away, but you want access to money. If you're 40 years away from super, accessing super, you might not want to lock all your surpluses into superannuation. That's all it is. It's all.
Awesome. Thank you.
Yeah, it's very much a individual choice. So you want to talk to a planner and talk to a mortgage broker to go in length about all of that. Cool.
We've got another comment in the chat. So William here wrote, it's eye-opening to discover that HEX debt falls under bad debt, especially since a substantial portion of those eager to enter the property market are young individuals like myself, who are often saddled with considerable amounts of this debt.
Unfortunately, you can look at two ways, William. Though it can be a good debt, because if you did university degrees and whatever else, tertiary studies, and that allow you to earn a good income, a better income, a higher income, then that money is well spent as a HEX debt. All right. But if you go from the definition of, does that money work for you, and it's locked away, it's not working, then that becomes a bad debt. All right. So unfortunately, you either pay that up front, or you go through HEX. I went through HEX for all of my school fees, and there's a lot of school fees out of that. I can say that I don't consider it that bad, because I did end up with degrees and masters and all of that sort of stuff, and that allowed me to earn what I'm earning now. What you need to make a conscious decision on is keep an eye out on the annual indexation amount for the HEX. Okay, the annual indexation is the interest rate for your HEX debt. The last one that we had, because of high inflation, was 7%. Means that your HEX went up by 7%. So if that's the case and you've got the means and ability to do so, you might want to reduce your HEX debt. If you put $10,000 into a savings account, it might give you 4.5% return taxed. But if you put the same $10,000 in your HEX debt, you saved 7%. All right. So if you play that, you probably want to go into the HEX. All right. That is a separate issue to home loan affordability. The reason is, if you've got a HEX debt, regardless of how much it is, there's a set amount that will come off your salary, and that will be included into the serviceability. So unless you can clear the HEX debt completely, I would rather you have the deposit money. So I'd rather you don't pay the HEX back, have the money in your savings to borrow less from the bank, or show them that you got more savings. Again, these are things that when I speak to my clients about, we'll talk it all through, right? What's the right way? Do we pay off our HEX? Do we not? Sometimes we need them to pay off the HEX because we can't afford to take out the amount that the bank's taking out as repayments. We need that out of the calculation. In that time, we ask them to pay off the HEX if they can. Again, big if they can, because I can't understand HEX debt sometimes are overwhelming. But yeah, again, all individual discussions, I reckon. So if one thing that you come out of this webinar thinking is, talk to a mortgage broker early. Talk to us early so we can work out what we do for you. Okay. We can work out a plan. Yep. All right. Home loan applications. This is our bread and butter. What do we do here? So have a look at the next one. And this is very important. I get really irked when people go online and start putting in affordability calculators. All right, that is not accurate. I can categorically say to you that is not accurate. A lot of it, especially on things like realestate.com, those mortgage calculations and affordability calculators, don't believe in that. You want an accurate calculator. You want an accurate calculation. You want to be sure about this biggest purchase of your life. Talk to a mortgage broker. Talk to us. Talk to us. Talk to us. It's free, and I'll answer my calls at all hours of the day. Why? Because there's not one bank loan that fits everybody. There's no one bank that can do everybody's home loan. That is a God honest truth. If they can, there's no need for us to exist. There's no one size fits all. You got to work with somebody that will take your information wholly. They will take everything you got, work through it, and then knowing what the bank's policies are, and then fit them together. Now, I don't know all the bank's policies. So what do? Because I know your situation, I'll ring the banks. I'll ring 1, 2, 3, 4. I'll ring as many as I need to find a bank with a policy that will fit you. Again, that's what a good broker will do. We'll talk to the banks. We'll understand policies. If we don't, we'll ask them, all right, this is the situation. Does that fit? If it doesn't, what can we do? All right. So that's where it's important. So what you can do as a client is give us your whole pie. Tell us everything. Give us all the information. Don't leave anything out. I can't do something if by the time we get to the situation where I think I've got it, I've got the solution for you, and then something else pop out that you've got a car loan that you didn't tell me about. Now, we do credit checks, which will show us everything that you've got, but I don't always do them because there's sometimes that, a client comes through and they're pretty sure what they've got. And if I don't have to go through a credit check, then I don't. But I rely on clients to tell me everything. So don't be embarrassed. Look, there's absolutely zero surprises for me. I've been doing this for 10 years. I've seen it all. There's no embarrassment. There's no income too low. There's no deposit too small. If it's too small, there's no judgment. If the income's too small or the deposit's too small, we'll work ways through it. We've got ways to work through it, okay? We've got ways for you to go away and knowing exactly what you got to do next, all right? So importantly, with your home loan applications, etc., don't leave anything out. Tell us everything, and then we'll be able to find the right one for you. Yeah, so again, the key points there, you've got paying off debts potentially. That's what we talk about there, William, about HEX. Sometimes we might need the clients to pay it out. It's all to do with that affordability piece, the calculation, net income minus expenses, minus your current debt and proposed debt. If that's a positive at the end, then your affordability is there. Now, if you've got 2 car loans, then that takes a lot out of your net income, okay? Because there's obligations, repayments there. You've got a $20,000 credit card, all right? That takes a lot of your obligations there. Now, I'll jump in here with a credit card. That's another thing that a lot of people talk to me about. I've got a $10,000 credit card limit. Yes, I understand that, but I don't ever owe the bank. I don't get charged any interest. I don't owe the bank. So I'll put 0 on credit card when I'm answering your question, mortgage broker. That's incorrect. $10,000 limit from the bank means that you can take the credit up to $10,000 without their question. All right, you can go out today and spend $10,000 and owe the bank $10,000 without them knowing about it. Well, without their approval. All right, because you're pre-approved $10,000. So when you're going for a home loan, the bank's going to say, right, $10,000 limit. That means as a minimum, if you scratch out your $10,000, so you spend all 10 grand, you owe the bank 10 grand, monthly, you got to pay them 3.8% as a minimum repayment. All right. So if you got a credit card, I urge you today to go to your credit card statement. All right. If you have any money owing on it, have a look at the minimum repayment. It's 3.8%. All right. That's your monthly minimum repayment of what you spend. So if you got $10,000 limit and you used all 10,000, you need to pay them $380 back. That's as simple as that. That $380 doesn't even scratch the surface of what of the principal you need to pay them back. So often on the fine line, you'll see that if you pay the minimum repayment, it will take you 22 years to 24 years to pay this debt back. All right, so don't owe anything on the credit card, please, because it's really, really bad. So all jokes aside, if a client presents with me with a $10,000 credit card limit, I need to put down 10,000 limit on the application, and be sure you see $380 go out as a monthly repayment for the credit card, not the amount you spend, but the limit. So if you have a $20,000 limit, that's $760 a month they will take out of your net income. That is a massive hit to your affordability. So often we need to ask clients when they're applying for a home loan to reduce their credit card limit if the affordability is an issue, or even close it completely if affordability is an issue. All right. And often we ask clients to close, HEX debts or car debts only if they have the means to do so. Okay, so that's where that paying off debt potentially can strengthen your application. What else we do? Yeah, we understand. Yeah, we understand all of that sort of stuff about what the banks offer. We understand, and we can explain what offset account means, what variable interest rate is, what fixed rate interest rate is. We've got all of that information there. And again, often people ask, "Oh, should I fix my interest rate?" That again is dependent on the times, and it's not something that's just as easy as, yeah, you can do it now, or no, you don't do it now. It's something that we have to discuss in length. I'll park that interest rate one, the offset and variable and fixed, to another time, because that's a pretty big and heavy discussion around that. It's to do with the interest rate environment and everything else, and also your personal financial situation before you can decide on fixed or variable, because massive obligations either way you go about it. Right.
Interest
That's a lot of
rates.
talking from me.
No, I'll take it from here, but I'm going to hand back to you, Jamie, anyway. So I'll take you through a bit of the basics. So let's go through interest rates 101. So don't be scared of the media hype. I think it's important that we try to understand what interest rates are and the parties involved in this. So just as a simple breakdown, what are interest rates? So you need to think of them as the rent that you pay the bank for borrowing money. So it's essentially that rate or that rent that you pay is adding up over time against your home loan. So this is just the rate that you pay for them giving you a bunch of money to go and buy a house. Now, who is the RBA and why are they important? They're the Reserve Bank of Australia. You have to think of them like the captain of the Australian economic ship. So they're driving the economy, they're helping moderate the economy so we don't crash. And what is inflation and how does it affect the interest rates? Inflation is basically like a thermometer for the economy. So when the interest rate, when inflation is up, they need to have a reaction. So let's go through what that looks like. And I'll use an example. So let's go through it. Interest rates went up because of inflation. Inflation is the increase in prices of goods and services that households buy. So this is like supply and demand. So this is your petrol, groceries, your shopping, like when you go to the shops, retail shopping. It can be home loans or purchasing a home. And then you've got your gas, electricity bills and things like that. So inflation is the increase of those goods and services. Now, what caused that increase for inflation was the war in the Ukraine, fuel and energy costs, and the demand for supplies in Australia post the pandemic. So what happened was supply was really low and the demand was high. So let's go back to that time in COVID, even though we probably all have PTSD. So when we were in COVID and we were in lockdown, what happened was we all started either saving money. Unfortunately, some people lost jobs or lost their livelihood. But one of the main things that came out of it was our spendings went down because we weren't doing our regular activities. We weren't going to restaurants or going away on holidays or going out or spending money at the shops. We were at home. What that meant was, if you remember, petrol was really cheap because not many people were on the roads anymore, only specific jobs. The groceries were a lot cheaper. And what happened was there was a switch in what we were paying more for. So our gas, electricity bills, all of that went up a little bit because we were using it. We were home 24/7. So then what happened was lockdown was lifted and we were allowed to go back out again. And when we did that, all at once, the entire economy was unleashed and allowed to go back to restaurants, back shopping, go to concerts or go to events, go driving on the road. Holidays, we were all allowed to go back out. And what that means is because the demand was so high, supply couldn't keep up. So with supply, you also hear the term supply chain issues. What that means is Australia relies on import and export of certain goods. So they will get it cheaper overseas to bring in certain materials. This is what impacted the building industry. So when those materials are, closed up because some countries closed their borders and Australia couldn't import those goods anymore, they had to start producing them here, which means it was more expensive to do. So when that became expensive, the government had to offset the cost onto the economy. So we pay more. So what this means, the RBA then puts up the interest rate. Why do they do that? Because they need to reduce our spending. It's done on purpose. So they reduce the amount we spend, I guess, by capping us, forcing us to look at a budget. So we're going to stop going out as much. Maybe we're not going to buy Uber Eats every night. Maybe we're not going to do all the regular activities as often as we're doing them, because the bank and RBA is trying to reduce that spending because there's not enough supply to be distributed across the economy. So we need to slow that down, and that's what they do. Now, why they do that is they want to reduce the amount of demand there is for the goods and services. So it's a necessary evil, because if we look at what would happen if they didn't raise the interest rates, let's say that they left the interest rates around that 2.5-ish% that they were in COVID, it means that there's higher inflation. It would keep going up. So that means all the stuff that we're paying for, like with groceries or shopping, and we're complaining now, it would only get worse. It would make it a lot harder on us to be able to afford those things, and it would lead to a crash, which are devastating financial situations in the economy. Then there's a bubble risk. This is in particular with houses. So where that causes a big financial crisis with like a housing bubble, it just explodes and goes off the charts. So when does the inflation rate, or when do the rates come back down? So RBA recently announced that they're going to reduce the rate, and they already have. And they do that because they need inflation to gradually come back down to the 2 or 3%. That's their target range. When it started, it was around 6 or 7%, the inflation rate. And that's why they had the reaction to try and stop our spending. So like I said, it's one of those things that, yeah, it's a bit of an annoying factor that we're paying, a lot more for our loans, or maybe a lot more for general activities, but it's done on purpose. And it's not like that forever. It's to stop the economy from completely crashing. And it's to make sure that once we come back down to responsible, buying, and we have a balance of supply and demand, it happens gradually over time. And that's when we can go back to normal, and we should see costs of living and everything like that return to some sort of normalcy, like pre-COVID, potentially. But we don't have a crystal ball. We're going by the play-by-play with the RBA. So that's a bit more about how it explained and what it means and how it impacts everything. Jamie's going to take you through a calculation in how this impacts potential home loans.
So thanks, Jo. And again, we're not economists here, so we can't predict the interest rate. But Jo done a really good job explaining what inflation and the monetary policy, how they're correlated and how they work. And Jo is absolutely correct. It's the only lever that our government's got to I suppose, manipulate the market a little bit. So. But one big thing to everyone's heart is this interest rate that we keep hearing about, what we're paying on our home loans or potentially paying on our home loans. How is it calculated? I don't reckon a lot of my clients don't know this. I don't know how many people actually know how the interest rates are calculated. You often hear and you often see 6.25, for example, there per annum behind it. All right. So this is the annual interest rate. How do the bank calculate the interest rate? They calculate it daily, and they charge it monthly. So you hear it is 6.25 per annum, calculated daily, charged monthly. That's how most things are calculated for home loan anyway. So let's see how that works. A $500,000 home loan at 6.25% per annum, 6.25% per annum over 365 days equals to roughly 0.000178% per day. You owe $500,000 on that day. That means $89.04 per day. You have that carried over 30 days. That's $2,671.23 of interest for that 30-day month. You made a repayment on that $500,000 home loan at 6.25 per annum over 30 years of $3,079. That's your monthly minimum obligation on that loan. You made that payment on the monthly anniversary of your home loan. In actual fact, out of your $3,079, you paid $2,671.23 of interest. Therefore, your actual principal repaid is $407.77 for that month. Now, that's a pretty dire situation, but as it works with amortization and as it works with compound interest, that because your principal is shrinking, that amount will shrink, the daily interest will shrink, everything will shrink, and then it will get to a stage 30 years later that you have zero left. All right. So we often say the more you repay, the more goes into your principal, the less interest you'll be charged. And therefore, by the end of the loan term, you won't be 30 years. You'll be paying it off earlier. Quick tip on how to do that, and it's not on my slide, but quick tip how to do that. Just remember it. The more often you pay your home loan, the less interest will get charged. So if you have the ability to pay weekly because there's 4 weekly payments per month per se, or 52 payments going into your home loan, reducing your debt per annum versus 12 payments. Okay, so if you think about it that way, the more payments you pay, the less interest will get charged because it's calculated every day on the balance left over. People often talk about offset accounts. You have money in your offset account, that will reduce the interest charged. Again, that's something that we can discuss on another topic that we'll follow up with another webinar at some point. But again, those are just 2 quick tips. You want to put as often as possible on repayments. They'll reduce the interest because it's calculated daily. On the right-hand side, there's just a screen grab of what it looks like on your bank balance. If you look at from the bottom there, balance of $903,016, or $116. Repayment of $6,054 went in. All right, and then the next day or two, $30 came out as fees. Again, most home loans don't have that anymore. And then $5,565 got added onto the home loan. So balance went from 903 back up to 908. And then a month later, made another payment of $6,000. It went down to 906. But again, the interest got charged again, went up to 907. That's how it works. That's what you're going to see on your home loan statement. Repayment going in, interest gets charged. All right, your balance is negative. It goes down a little bit, and the interest gets charged. Your balance goes up a little bit again. All right, so that's just a typical example of what it looks like. All right, every home loan statement looks like that, no doubt. Your one won't have that $30 fee. That's a commercial loan. That's what I'm showing. The commercial loans normally have a fee on there. All right, so that's how you calculate interest rates.
Sorry, my slide jumped way ahead. But just to add to that, I think what's really important to remember with the interest rates here, and this is what we'll go through now, is it's dependent on your situation. So a lot of the time I get asked the question, is it the right time to buy? When should I buy? And I think this is something Jamie and I often talk about when we're helping clients, is this particular question is really dependent on you as a person. It's nothing to do with markets. And what I mean by that is we can't predict exactly what will happen. So no one predicted COVID, for example, and how the property market was going to react. So what we go by is by saying, if you've got savings, if you have the desire to buy a home, or you're motivated and it's the right time in your life and your situation, or maybe you're not sure, talk to one of the professionals like a broker, but also make sure it's the right time for you, okay? Because if you wait 6 months, we can't tell you what the market will do. It might be better for you to buy in 6 months. It might be worse for you to buy in 6 months, but we don't know. So you base it off the market that you're in. If you're in that financial situation where you've done your savings, you've got the motivation, you kind of have the I guess luxury of time to make that decision, base it off your own personal situation. Don't base it off the market at the moment, because the market changes so many times, and there's so many trends throughout the month or throughout the season of a market. So make sure it's the right time for you. So that's why with rates and this topic, it's really important to know that it is about you. It is about your personal journey, and interest rates are what they are when it's the time for you to buy a home. And if you look at maybe the era of like our parents or grandparents, they went through interest rates that were up at like 17, 18%. So this isn't even as bad as they've seen so far. And they've still survived it. They still have their homes. They still purchased. And that was the cash rate back then for their income as well. So just something to keep in mind, that base it off you, not the entire market itself.
Yeah, it's a good point you make there. And I'm conscious of the time, but I often hear people saying that, okay, you know, I don't know if it's a good time to buy now, or should I wait for the, you know, house price to come down a little bit, or interest rate come down a little bit. One thing is for sure, we are in a free market. It means this is without outside control. It's completely supply and demand. That's what a free market is, right? And what that means is that the consumer sentiment, so what you think, what you believe, and what everybody in the cohort believes drives the market. So if everybody who's got enough affordability and deposits and everything else are in the market, but thinking, okay, the house price is going to drop in the next 6 months. If everybody thinks that, then guess what? No one's buying, and the price will drop quickly. Okay. If the price drops quickly, there's also a bunch of people sitting there with a bunch of money going, hang on, the price has dropped. All right, I'm going to buy now. And very quick, the buyers will be flocking to auctions again. And I bet your bottom dollar, the price will skyrocket once again really quickly. So the moral of the story, we don't predict it. We cannot predict the bottom of the market. We cannot predict the peak of the market. And Joe is absolutely correct. If you're making a purchase, you need to make it on the back of your financial strength, your lifestyle, and what you want to achieve out of it. There's always stories about people bought at the right time, and people bought it at the wrong time. But if you make the right inquiries and you go through all the things that you need to tick off, and you make a purchase, I think you'd be well looked after in that regard, and you don't have to worry about bad time or right time or wrong time, because honestly, nobody can predict it. Nobody can put their hand on heart and say, oh, you know, this is absolutely best time to buy, or this is the absolute worst time to buy. And again, it's also driven by other circumstances. For example, as a renter right now, it's the worst time because everyone's increasing their rent. Sometimes it just doesn't make sense. All right, think about it. If you're renting right now and your rent's going up 10, 15%, you got to come up with that 10, 15% for someone else's mortgage, number one. Number two, you still need to save for your own savings so you can have a decent deposit and purchase later. So you got to have all of that. So you might as well work out what you can borrow and what your repayments are going to be, and then see what you can do with that information before you commit into further renting. All right. So those are the things that we can work out. We can work out, both Abodey and myself, Joe and the team and my team can help you with, is to sit there and work out, is this the right time for me as an individual? There is no right time or wrong time if you don't know, if you don't have the information. All right. So I think that's the biggest takeaway I can give to everyone. Use us because we are what we are. We are what we do. We have the information, and given us your information, then we'll be able to help you and make sure that you go into things with a loaded gun. You know, with all the information you need.
100% well said, Jamie. And sorry for keeping everyone a little bit over time. I'm conscious that we want questions as well, if anyone does have any questions, but we can always get back to you as well via email, or you can reach out to us on our social channels. It's up to you. But does anyone have any questions before we wrap up? I'm going to take the silence as a no unless it's in the chat. Just double check. No, all good. Well, like I said, guys, and like Jamie said, Jamie and I are partnered together with Vigeo and Abodey. So we help buyers basically find the right fit homes. That's where my role comes in. And Jamie helps on the financial side. And our goal is to make sure that people feel, you know, empowered, secure, and understand the journey of home buying rather than feeling like they're fumbling through it. So I hope you guys learned something or got something out of today. We're going to do a series of these events in the coming 2024 year. And we would love your feedback. So once this session is finished, we'll send out an email with the package, with the recording as well. So you can have our pack for notes and some additional information that might help you. And we are always here for you. So if you need anything at all, please reach out and we'll keep you posted for future events. But thank you so much for attending our very first webinar.